Thank you, John, for the introduction. Thanks to you and to Gash for organizing this and for the invitation. What I'm going to be talking about today is a very high level. I'm not going to go into any real algorithmic details at all. Really high level description of 3 projects that we've been working on using transaction level investment account data from personal investors. And so what I'm actually going to do, I'm going to describe the 3 projects. First, I'm going to describe the Financial Wellness Lab, which is sort of the vehicle that's how we got the data. And then I'm going to describe 3 projects. The first one there is actually a paper that's been published with John as a co-author, the lead author actually. And then 2 projects that are sort of in progress. One of which, the Replicating Financial Advice Project, we're actually building an app for one of our partners. And then the Savings and Investment Project is something that we are currently working on and hope to publish in the reasonably near future. So just a really quick idea of what the Financial Wellness Lab is. For those, the writing here is a little small, and so if you can't read that, the goal of our lab is to develop quantitative finance and data analytics solutions that will enable Canadian households to enhance their financial resilience. An important point here is that everything we do at the lab is data-driven, involving data that we get from our partners. It's hosted at Western Science with collaborators at the Ivey Business School, Wilfrid, Laurier, UBC Okanagan, University of Winnipeg and York. Mostly sort of stats, math departments, and then also business schools, really interdisciplinary. So that's us, that's the lab. Here are a few of our partners and our funding. We have had some funding from Fields, and we also, our primary source of funding right now is a large NSERC Alliance grant that is keeping us going for a few years. Key partners, the National Payroll Institute, formerly the Canadian Payroll Association, Aligned Capital Partners, Ceridian, and LifeWorks. And all of our partners provide money, but most importantly, data. Very large amounts of data. Okay, so that's us. That's the little plug for the Financial Wellness Lab. So what I'm going to do now is I'm going to talk about a project I worked on with John. John led this project, talking about elicited and revealed risk. And so where this all started was what we thought was a really simple mathematical problem. And so we've got, that was posed to us by one of our partners. And so we've got, as inputs, we've got 2 portfolio allocations. And I should probably explain this. I've got my prescribed portfolio here. And these are allocations to 5 risk buckets. So every security that is sold in Canada has to be categorized in one of 5 risk buckets. We've got low risk, low, medium, 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 high, high risk. And so this prescribed portfolio here, this would be an advisor's recommendation to an individual who they've met with and communicated with. And so this prescribed portfolio would be 25% low risk, 40% low medium, 35 medium, so on and so forth. There's nothing in the medium, high, or high. And then what we've got is we've got an actual portfolio. So the advisor made the recommendation and said, here's how I think you should allocate your wealth across the risk spectrum. And then what we have below is what the individual is actually holding right now. And so as we can see here, the actual portfolio can deviate quite substantially from the recommendation. Does this happen often? Yes. We've looked at thousands and thousands of accounts, and deviations between what the advisor recommended and what the investor is actually holding are extremely common. They're the rule, not the exception. And so what we want here as an output is a single number. And what we want is how far away is this actual portfolio from the prescribed portfolio. And this is important for a variety of reasons. An individual is thinking about making a trade. Is that trade going to move them closer or further from the advisor's recommendation? Portfolios drift, and if an investor is trying to stay within the prescription, as asset values change through time, there's drift, and so you could use this as sort of a warning signal. You're getting too far away from the prescription, you need to bring it back. A whole bunch of different very pragmatic and very practical reasons why you would be interested in a sort of a distance like this. As it turns out, I mean, this seems like a really simple measurement problem. And when we heard it the first time, we said, okay, no problem, right? We're just talking about the distance between two vectors. Or if we want to get a little bit more sophisticated, we're talking about the difference between two probability distributions, right? We'll use Kullback-Leibler divergence, or we'll use Hellinger distance or something. Simple objects should be really easy to measure this distance. As it turns out, it's not nearly as simple as we originally thought. With some of the, the Kullback-Leibler divergence, if the advisor didn't recommend a certain category, then it's sort of completely ignored in the calculation. If you just treat these things as two vectors and use like a Euclidean distance, the difference between 100% low and 100% medium low is the same as the difference between a 100% low and 100% high. And so the problem is not nearly as straightforward as we thought it was at the beginning. And so we tried a lot of different things, and we would take our ideas to the data, and we said, okay, we have somebody who made a trade. We see that the trade moved them closer. Does our metric accurately say that? And sometimes we'd see things that were, okay, the client clearly moved closer to the recommendation, but our metric says they moved further. That's clearly not going to work. Okay, and so the solution that we settled on is we're just going to choose one representative asset from each risk bucket. Okay, and what we're going to do, so these would be, liquid, an ETF with a very long history, very liquid ETF from the low risk bucket. And then we pick one from the medium low, so on and so forth. We calculate the historical means, volatilities, and correlations of the returns on those ETFs. And then what we do, and it's a relatively strong assumption, but we've tested it and sort of doesn't really, it works, is we assume that every dollar invested in a particular risk bucket, so I have an advisor, or sorry, I have a client, and they have 10% in low. What we're just going to do, for argument's sake, is we're going to assume that every dollar invested in a particular risk bucket is fully invested in that representative asset. And so we're not being completely faithful to the client's actual portfolio, but we're close enough. And then once we have a sort of this, I don't want to say fictitious, but this representative portfolio, what we're going to do is we're going to compute the corresponding value at risk for each portfolio, the prescribed portfolio, the allocation that the advisor said was that the advisor recommended, and then we're also going to compute the value at risk for the actual portfolio. And then once we have these two values at risk, we're going to measure the difference between, we're going to take the difference, and that's going to tell us how close or how far you are from the recommendation. And the thing about, a positive difference would mean maybe you've got too much risk, and a negative difference might mean you don't have enough risk, and that's how we're going to measure things. And so what is the data that we tested our approach on? We have transaction level data for over 50,000 different investment accounts. These are individual investors between, that would be April 2019 and September 2019. And with our data, a given client, a given individual could have multiple accounts, like an RESP, an RSP, a margin account, maybe a non-registered account. Different individuals can have multiple, or different clients can have multiple accounts. And so those 51,000 accounts are spread across almost 28,000 clients. And I'm pretty sure this number is right, 300 advisors. The ratio actually, when I was looking at these this morning, seems like it might be a little bit big. But we've got hundreds of advisors, thousands of clients, and thousands of accounts, right? So we have a lot of data to work with. And so what we do is for every one of these accounts, and on every day, we compute the difference between the actual VAR, the value at risk of their actual portfolio, and the prescribed VAR, the VAR of the portfolio that was recommended, or the allocation that was recommended by the advisor. And then we'll sort of average that through time, but for now. So what does it mean if the difference between, so if the actual VAR, if I take the actual value at risk and I subtract off the prescribed value at risk, what does that mean if it's negative? What does that tell us? Anybody want to venture a guess? Where is the client relative to where the advisor said they should be? Here's where I am, here's where my advisor said I should be. If I take the difference, actual minus prescribed, what does that mean if it's negative? Yeah, I'm sort of under risked in a sense, right? My advisor said I should be here, I'm actually there. Absolutely, right? So if this difference is negative, it means that one way to phrase that would be to say that the investor is under risk. And what does that mean? Well, maybe the advisor or maybe the client gave the advisor some investment goals. When I retire, I want to golf at these courses this many times a week. I want to take this many vacations. I want to eat at these kinds of restaurants. What this means if it's negative is potentially, you say you want to be here, but you're investing here. There's a gap. And so you either need to get your foot on the pedal or you need to set maybe some more realistic goals, right? So very meaningful. What does it mean if it's negative? It means there's a gap. The way you're investing is not commensurate with sort of where you said you wanted to be with your investment goals. And if it's positive, it's the exact opposite. The advisor said you should be at a certain level of risk and you're taking on a little bit more. Or maybe a lot more than the advisor feels is appropriate, right? And that could be a problem if you're an advisor, you really want to pay attention to this. In any event, this is what the difference is, and this is how we interpret it. And this is one of the things that we didn't get when we used those things like Kullback-Leibler divergence and Euclidean distance, is we didn't get this sort of under-risked and over-risked. And that was really what was missing from those calculations. Okay, and by the way, for the people online and the people here, by all means, if you have a question, interrupt me. We don't need to wait till the end if you have any questions or concerns. So just as sort of a smell check, right? We looked at how prescribed VAR varies with things like income and investment knowledge, and it is positively correlated. And so what does this mean? Advisors are advising less risk for people with lower incomes, more risk for people with higher incomes, which is kind of as we feel they should. Also positively correlated with investment knowledge. So the lower somebody, if I report a very low level of investment knowledge, I'm going to be prescribed a lower VAR than somebody who reports a very high level investment knowledge. And that makes sense. And it's negatively correlated with age, which, older individuals should be, as they get close to retirement or are in retirement, should probably be taking on less risk than those that are younger, 20, 30 years old, right? And so what we did is we looked at everything that we did. I should say this, every sort of check like this that we did suggested that advisors are giving good advice. Because we said, okay, so if advisors are giving good advice, we should see this sort of relationship, between age and prescribed VAR. And in every case, it worked out the way we expected it to. Margin accounts have the highest prescribed VAR, RIFs have the lowest, right? And we compared a whole bunch of, so a RIF would be like, if you're retired, you convert your RSP into a RIF. This is retirement income. Okay, and so everything, everything behaved as we expected it should. The metric that we're using here, the difference in value at risk, appears like it's measuring what we want it to measure, but also it appears that these hundreds of advisors that we have in our sample are giving good advice, right? And that's a good thing, that's a positive result. And so what we do, we look at the VAR discrepancy across all of the accounts. Okay, and we looked at this we looked at it by the advisor level, by advisor. We looked at it by account types. We looked at it, we had done some clustering on sort of trading behaviors in a previous project and looked at it across those clusters. We looked at it in every way. And you saw this discrepancy no matter how you dissected the data, you saw the same pattern. And so what we have is we have this discrepancy in VAR, and so we had calculated the discrepancy on every day for every account, and then to produce this, we just averaged for a given account. We averaged that discrepancy through time, and this is what we're reporting here. And so what you see is that the distribution is, it's probably centered to the left of 0, and then it's heavily skewed towards negative values. The vast majority of individuals in this data set are under-risked, right? The discrepancy is negative, and we said before, that means the advisor said you should be here, but you're actually coming in down here. You're not taking on as much risk as your advisor said you should be, all right? And again, I can't reiterate this enough. No matter how we look at the data, no matter how we break it down by account type, by age, no matter how we looked at the data, we always saw this pattern. Okay, and so what we see is that the actual VAR is consistently and systematically lower than the prescribed VAR. The individuals in our sample are consistently and systematically taking on less risk than their advisor said they should. And so our original thought, and I think there's probably a grain of truth to this, but our original thought was this is completely advisors reasonably and understanding protecting themselves. And so if I think that you should be at, like, say your VAR should be 3%, I'm going to say you should be at 5%, just so that you invest, so I give myself a little bit of a buffer, right? Nobody's ever going to get sued if the actual portfolio was a little bit less risky than what was recommended. And so we thought that originally that kind of explained everything, and it maybe has something to do with it. But then we got a new set of data from a robo-advisor. So these are individuals that are not interacting with a human. They're filling out a survey, answering a couple of questions online, and then they're getting a recommendation there. And we have thousands of them as well, completely separate, different demographics. Our robo-advisor individuals were much younger, much less wealthy. Our actual advisors that I'm talking about here, or individuals that I'm talking about here, were wealthier, older, more savvy. And we think we see the exact same thing with the robo-advisor data as well. Whether it's a human or a robot telling you where to be, you're going to back off a little bit and come in underneath that. Okay, there's still, this with the robo-advisor data, this is still a work in progress. There are maybe a couple of potentially confounding variables that we haven't really explored that could explain the gap, or remove the gap, I guess. But we think we do see that gap with the robo-advisor as well, which is really interesting, because then it sort of speaks to maybe this is just human nature. Like if somebody tells you you should be at, we're risk averse, that's our nature as humans. And so it's almost like if somebody tells us you should take this much risk, we're going to back off it just a little bit and be a little bit more conservative, because that's the way we are as human beings. And so if that's the case, and in conversation with a lot of our partners, we think this probably actually is the case. The important problem is, how do we encourage individuals to take a more appropriate level of risk? Or how do we get them to set more realistic retirement goals, right? Because what this gap is all about is, I'll say this is where I want to be when I retire. An investor says, okay, or an advisor would say, okay, this is how much you need to invest. This is how you need to invest. And if I'm taking on a little bit less risk than is recommended, then I'm probably not going to meet my retirement goals. And so I need to do one of two things. I need to either set more realistic goals, or I need to be comfortable taking on a little bit more risk. Okay, so this is project one. Really fascinating, open question. Why is it that whether they're interacting with a human or with a robot, a computer, why do people always systematically come in below where the recommendation is? We don't have an answer to that, and I don't think what we're good at is we are good at spotting patterns in data. Explaining why we see this is not necessarily our mandate. I think there's probably a lot of interesting psychology and behavioral economics underlying this. I'm not sure that we're going to be the people to answer this question, but we can sort of document the phenomenon for sure. Yes.
This seems like a very good insight and a very interesting one. And I'm thinking that if people are more aware of this, they might be changing their decision over time.
Yeah, so that's a really good question. The time frame that we're looking at in this project, John, we say it's a little bit too narrow to really. And so what we've got is, actually we should maybe revisit this. We've got more data from. We recently came into possession of data from a longer time frame, and so we should definitely explore that. Yeah. Okay, so that is project one. Project two involves replicating financial advice, and I'll be very careful to say replicate and not replace, because we're training. Well, I'll get into that. I'll get into that more in a moment. Just note that I'm using the word replicate here and not the word replace, and I'm doing that very intentionally. And so where this came out of was actually, it was a Fields multiplier project. So this was funded by Fields and one of our partners. And what we're doing is we're essentially building an app, and we've delivered the beta version of the app, and we're just waiting on feedback from that for individuals in the group RSP space. And so I will describe what we did in more detail now. So the basic problem that we're faced with here is we have an individual and they're beginning to save for retirement, and they are doing so through a group RSP. So if you don't know what a group RSP is, it's like an employer-sponsored program. When you're hired, you tick a box and you say, okay, you take 5% of my salary and put it into this registered account, and then the employer will match, right? And so if you go 5, they'll go 5, you go 7, they'll go 7. So this is the idea. It's a group RSP plan, and we've got somebody who's coming in and they're beginning to save for retirement. They're doing so through this group RSP. What this means is the target audience, likely young, probably their first job, with little to no savings because they're young, and perhaps more importantly, very little investment knowledge. And so this sort of ties back with, we saw in the previous talk, people who maybe just really don't know anything can benefit really. There's a lot of value in very simple advice for such individuals. That's the kind of individual we've got here. They really don't know a whole lot, and that's fine. It's not that they're ignorant, they just haven't thought about this before. And they're likely intimidated by the whole process, right? Many of, if we're in this room here, we are quantitatively oriented individuals. And that is, I would argue, probably the exception, not the rule. Many people, many individuals don't like thinking about these things because they find them intimidating, and that's fine. Okay, and so what we're trying to do is we're trying to answer the following question. Had this individual had access to a professional advisor, what would that advisor have recommended, right? And you sort of think about this, and if you think about individuals who, like, in order to work with a human advisor, you have to have a certain amount of wealth accumulated, and it's a very small fraction of the population, at least in Canada, that has enough wealth to work with an actual human advisor. And so it kind of, there's a huge swath of the population that's probably underserved when it comes to financial advice. And so at sort of a higher level, we've got this really specific group RSP problem, but at the next highest level of abstraction, really what we're talking about is replicating financial advice, professional advice, for those that would not otherwise have access. Okay, and again, I'm not sure how to get rid of that. My last bullet point here says replicate, not replace, using that word very intentionally. We're going to train models to learn the decision-making process that a professional advisor would go through. And, the fact that we have decisions that are made by a lot of professional advisors is an important part of that process, right? We're trying to learn how the experts process information and replicate that. We're not trying to replace the expert, right? If we didn't have the expert advice, we couldn't learn anything. Okay, so I always make a point of trying to be very clear about that. Okay, so what's the data that we're looking at here? Same data source, but slightly different data set. And so we have almost 5,000 RSP account applications that were completed with a specific one of our partners' advisors between July of 2019 and February of 2021. So there are almost 5,000 account applications, and the way this application would work is you would sit down with your advisor, you would have a conversation, They would ask you questions, they would record your answers, and then once they have your responses, they'll process those and they'll make a recommendation. And so what we have, and I shouldn't say KYC here, this is actually a typo. KYC means know your client. What this should say is RPQ. RPQ. So that is Risk Profile Questionnaire. So the KYC will collect basic demographic information. How old are you? How much do you have invested outside this firm? How many dependents do you have? You know, what's your gender? All sorts of things. So that's what the KYC would ask. But then we also have more specific risk profile questionnaire. So questions about, you know, your attitudes towards risk and things like that. Okay, so what we have for all of these individuals is their response to every single one of these questions, a couple dozen. And then what we have is we also have paired with that is we have the recommendation that was ultimately made by the advisor. And this would be, the recommendation is almost, imagine that response variable is like a Likert, 5-point Likert scale. You know, we don't have a very specific portfolio, but what we do have is, you know, you should be in income, you should be in growth, you should be in aggressive growth, and you can order those. And so our response variable here is essentially a Likert or an ordered categorical. Oh, and that's what I say right here. The recommendation is 1 of 5 risk levels. Okay, and so the question that we had is, can we build an algorithm that mimics the professional advisor's thought process? Okay, and if we can build such an algorithm, then we can solve the problem we had on the previous slide. We can actually say, okay, answer these questions, and we can say with 90% certainty the advisor would have told you this. Now, we're not talking about any tax, like we're not talking about high-level financial advice. We're talking about just sort of where on the risk spectrum should you be invested. There's a whole bunch of other things that an advisor might do that we're not addressing here. We're addressing a very specific feature of financial advice. Okay, and so the first attempt was just using nearest neighbors with demographic features. And so we said, okay, demographic features, how old are you? How much do you make? What is your gender? Things like that. And it was just, it couldn't have been, it was an epic failure. And so what we were doing is we were just giving everybody the average recommendation. This was an epic failure. In the interest of time, I'm not going to ask the question, wait for a response. Why did this fail so badly? Because advisors pay attention to much more than simple demographic. How old are you, and how much money do you make? Okay, so that's why the nearest neighbors with these features failed, because we weren't incorporating any of the things that that advisors really pay attention to. They look beyond, way beyond how old are you and how much money do you make, and that's why this first attempt failed. And so again, responses to all KYC questions should say our risk profile. Anyway, second attempt, we used all of the responses, and this made for, you know, more complicated code, much larger increase in computational time. We included all of the questions or the responses, and we used more sophisticated predictive models. I have a table that I'll show you in a moment. This was much more successful. We can get, you know, 90+% accuracy in our data. And so what this told us is advisors are paying, you know, much more attention, because this one failed and this one worked. The moral of that story is advisors are paying attention to much more than simple demographic information, like how old you are and how much money you make. Okay, and so this is just an idea of some of the models that we ran through. As you can see, I'm showing you this really to highlight the number in the top left, like gradient boosting worked the best. This is results of a cross-validation experiment, 91% accuracy. Looks really, really good. This is the model that we ultimately built and shipped. And so one of the nice things about these algorithms is it allows you, so number one is, yes, we can, with 90% certainty, if you answer these questions 9 out of 10 times, I can tell you what an advisor would have told you. We can also attach probabilities to these things and get a little bit fuzzy and say, okay, we're pretty sure the advisor would have said this, and if they hadn't said that, they probably would have said this. So we can get more sophisticated if we want to. We're keeping it simple, and this is the algorithm that underpins the beta version of that app that we shipped. There's also sort of an education piece that says, okay, your advisor said you want to invest here, you said you want to invest there. That could cost you $750,000 when it comes to retirement if you're not taking on enough risk, but that's a whole separate problem. Okay, and so out of the Light GBM comes a list of important features, right? And if you're familiar with ST techniques at all, you've seen a million of these plots. What's interesting, I can't give you the list of all of the features because that might sort of clue you'd see the exact questions that we're asking, and that's proprietary. But what I can tell you is of 20, 25 different features we fed in, income is only the 10th most important. Yes.
Just to make it clear, you are saying that given all these questions and the answers, you can introduce what the advisor would then say. But we don't know the ground.
Sorry?
We don't know the ground truth. What is the actual risk erosion?
No, we don't. And yeah, that's a really good point. What's the actual risk level that is appropriate for this person? We don't know that. And that's, we really try and make this clear. We're not trying to tell you what you should do. We're trying to tell you what an advisor would have told you to do. And so that's how we pass the buck there, if you will. Yes.
Eduardo was just saying, can you please repeat the question from the audience?
Oh, sure. Okay, so the question was, we don't actually know the ground truth, right? We don't actually know, we don't have access to what the actual level of risk that would be appropriate for this individual is. So that was the question, and my response was, that's correct. Again, what we're really interested in is just learning, can we tell you what an advisor would have told you? The default assumption there is that the advisor is giving good advice, and in that first project, we looked at all of that, the value risk data, and are confident that advisors are giving good advice. And so, yeah, the implicit assumption is advisors are giving good advice, and what we're going to do is we're going to replicate that advice. Okay, and then income was the 10th most important feature, which we found really interesting and is really consistent with stuff. We've done stuff with survey data on financial well-being and financial wellness, totally independent of investments and financial advice. And we found that, income is sort of important in determining where you are in the financial well-being spectrum, but it doesn't tell the whole story at all. Okay. So the answer to the question is yes, we can replicate the advice, and we're not going to replace the advice, but we can replicate it. Okay, the last, I think I have about 10 minutes, right? We're going to 10:30. Last project, and this one is ongoing, relates to savings and investment and behaviors that we see in our data set. Any idea what I can do to minimize this?
In the more, there might be a high floating meeting controls.
Amazing. Thank you, John. Now I think I've lost my ability.
Like the presentation.
Okay, perfect. Thank you. Okay, so the basic problem in 10 minutes, exploratory analysis. Let the data speak as loudly as it can. We're not going into this with any preconceived notions. We just want to explore the wealth trajectory for almost 7,000 RSP accounts that we have. For each of the accounts here, we have details on every single transaction, bought a security, sold a security, rebalanced, new contribution, dividend got reinvested, paid a fee to your advisor. We have details on every transaction between July 2019, February 2021. We've since come into possession of data that's covers a longer time frame, and we're trying to see if what we see here holds up when we look at longer data frame. And we also have data from a different source, and we're gonna check if our findings hold up there as well. Okay, and so what we really want to do when we explore is we want to identify underlying characteristics of good trajectories and bad trajectories. Why do people invest? Why do they seek advice? They want to grow their wealth. How that happens, I don't care. I want to grow my wealth. That's why I'm investing. That's why I'm talking to an advisor. And so we want to be able to identify characteristics of good wealth trajectories and bad wealth trajectories. And we want to be able to explain, and once we kind of understand what a good one is and a bad one is, what explains the good outcomes and the bad outcomes. And so what we're going to do is we're going to use unsupervised learning so that we can let the data speak as loudly as possible. And so what we're doing is, this is sort of, we're normalizing everybody to have started with $1. So whatever you had in your portfolio at the beginning of our time frame, we divide by that initial value so that everybody's on the same footing, essentially. So everybody starts at $1. This is a time series, a trajectory for one of the accounts in our sample. As with everybody else, sustained a bit of a downturn in March 2020, and then things rebounded really well, right? This is a market event. This is not related to the individual. What happened here is related. That's a lot of money that they put into their account. We don't see this here at all. I know it because I'm familiar with the data. And so there's really sort of two things driving the trajectory. There's savings and there's investment. And what we would like to be able to do is disentangle the two and sort of, you know, do a little bit of performance attribution. Anyway, we'll get to that in a moment. And so what we use is we use dynamic time warping to compare the distance or to compute the distance between the trajectories of distinct accounts. Dynamic time warping, the data is really lumpy and the transactions don't always happen at the same time. And so we need to use a distance metric that allows for comparing time series of different lengths and that don't perfectly sync up. And so that's why we settled there. And then once we have the DTW distances, we're going to cluster on those and have a look at the groups that emerge. And so we got 3 clusters, all right? And what we're graphing right here is we are looking at the market value of the account at time t. The underlined X here is the minimum value across the entire time period. I don't care where the minimum occurred. I just care that this is what the minimum is. And then the overline there is the maximum value. And so if we look at this is sort of our best group here. We've put them in the middle. This group started, so these are all the trajectories and they're average, so you can sort of see the middle. This group started near 0, so they sort of start, you know, their lowest portfolio value over the whole period was near the beginning, and they ended up near 1, which means they sort of started out here and they ended up there, and that's what you want to do. The second group, well, cluster 1, but I'll call them the second group, sort of started off in the middle, okay, so their lowest balance was not actually right at the beginning, and they ended up sort of in an okay place. And then the third group, things just didn't go well for them, right? So we have these 3 groups, and we want to kind of, we've clustered on the trajectories, and we want to dig a little deeper and see sort of what explains these 3 very different outcomes. So the middle group in gold, they have the best outcomes. The upper group in blue, they have the sort of median, the middle outcomes, and then the green group at the bottom has the worst outcomes. They suffered in March 2020 and never really rebounded. Okay, and so what we're going to do is for each account, we want to disentangle savings from investment by computing, number 1, the internal rate of return that was realized over the entire period, and that's going to give us investment performance. And then what we're going to do is we're going to use we're going to also compute the savings rate, but we're going to be, you know, normally when you think about savings rate is you think about like how much did I save as a proportion of my income, but we don't necessarily have that number. And so what we do is if we discount all the contributions at the internal rate of return, and you can work this out, you can prove this, and then you normalize by I'm going to take all the contributions and accumulate them to the end of the period using the internal rate of return. You can show this. You normalize that by the ending market value, and what you can do is you can interpret the percentage of terminal wealth that can be attributed to savings as distinct from investment performance. So by calculating the IRR and then, you know, discounting or accumulating all of the contributions to the account at that internal rate of return, we have two measures that completely characterize the investment performance and the savings performance. This is the graph that blew us away. So what I have here is the savings rate for each account on the vertical axis. I have the internal, so investment performance on the horizontal axis. And what we have here is we see, so cluster 2, that was sort of the best group. As we see, they have the best investment outcomes and the best savings habits. And so it almost seems as though those two things are related. Why should that be? And then we have cluster 1 coming in the middle, and then cluster 3 down here at the bottom. And so the interesting thing here is, and this is probably the last point that I'm going to make. When you look at this graph, it looks as though I've clustered on investment and savings, right? If you looked at this and I didn't tell you anything and said, okay, we've clustered on these two, you'd say, oh wow, those are two pretty good clusters. What we did was we clustered on wealth trajectory and how that behaved through time. As it turns out, it looks like that is, if you want to sort of cluster on wealth trajectory and wealth evolution and how you grew your wealth, as it turns out, it looks like that is almost tantamount to clustering on the savings rate and the investment rate. Okay, and so it almost appears as though we clustered on those two things, but we hid those two things from the clustering algorithm. It found them anyway, and so what that suggests to us is that these two things really do kind of drive everything. And furthermore, it looks as though, and this is what we're not sure of, and we have longer data and data from a different source. We're gonna look at this a little bit deeper. It almost looks as though good investment outcomes are positively related to good savings habits, which is not something we expected to find. Okay, had to rush through that a little bit in the interest of time. I'm done, and I'm happy to answer any questions that people have.